Powell gets to the podium, talks about what they did, but he specifically said they are not concerned about the economy, that they're in a healthy economy, and that this 50 basis point hike really wasn't to help the economy. It was essentially to get back to neutral. That's what he said. Get back to neutral, meaning that they may have felt like they were a little openly stated they were a little slightly restrictive, but this was to get it back to neutral. Now, I find that humorous because we're definitely not in neutral. When you have more people working more part-time jobs and more second jobs than you've ever had in the history of the United States, that's not a healthy economy. You know, when you have credit card debt as high as you have it right now because people are having to debt finance just to live, not their lifestyle, just to live, that's not a healthy economy. Welcome back to the What's More podcast. I'm your host, Quentin Harris, and this is episode 199. And it only took 109 episodes, but we are here finally. A Fed rate cut finally happened, right? 2 years later in the making, we've been talking about it, and we finally got a glimpse of it yesterday as the Federal Reserve came to the podium and talked about some questions they had and why they did what they did. And that's what we're going to talk about in this episode. Hey, the 50 basis point cut. If you go back to some previous episodes, that's what I had been calling for. I'm going to talk about why I thought that was going to happen. I'm going to talk about why it did happen. We'll talk about the impacts of that, what it means not only to the overall economy, but what it means to the households and people that are looking to acquire a mortgage. So welcome to the show. Can't wait to get started. So kind of let's break this down. If you've been listening to our podcast at any perspective, or if you know me as a person in the real estate community and in the banking community, I have been preaching the Fed rate was going to get cut at some capacity. And it wasn't one of those situations where, okay, if you say it enough, it's going to happen. There was a lot of ideology behind it. And if you go back to 22 and 23, we felt like we were delayed. We felt like there were things in the economy that were on the horizon that were predictable. But then there was a lot of unpredictable variable things like SVB, for example. You know, all of that kicked the can down the road and created this duration of the tightening and the delaying from the Federal Reserve to get to what we got yesterday. So what did we get yesterday? Well, we got a cut in the Fed funds rate of 50 basis points. Now, going into that meeting, I think maybe about 3 or 4 podcasts ago, I talked about as the employment news came out, how that was the deciding factor of why I thought there would be a 50 basis point hike. And at the time, even the CME Fed Watch tool was giving it about a 25% chance that there would be a 50 basis point cut. I specifically said, you know what? I don't know that it was enough, but I think there is just enough to get it done on a 50 basis point hike. And its reasons being is this. Inflation seemed to be the theme for the last let's back up. For about 18 months, inflation, target rate inflation of 2%. They've been hanging around the PCE core measurement with about a 2% handle on it, 2.5, 2.6, 2.7, 2.8, but it's been hanging around with the twos. And it would have taken them months of lower readings than what they're currently getting to get to just a 2 handle. And so you could almost get this sense that they had already achieved what they were trying to achieve, but even though they were sticking to it, the 2% was already achieved. So then there was a turn in theology and over the last 90 days to where Powell was actually talking about the labor market and the softening of the labor market and the strength of the labor market and the concerns of the labor market. And we started seeing Fed members come out saying, hey, listen, we think that the target rate of 2% is achievable without having to maintain the same Fed funds rate that we're having, hinting towards, well, we could probably cut. And then there was half of the group that came out and said, we're not real comfortable at this 3.8 unemployment rate dating back to about 128 days ago. And then over that 120 days, we saw the unemployment rate go up substantially from 3.8 to even crest at 4.4. Rather large jump, especially when you look at the amount of people that encumbers in that number. And what's interesting to me is that you had specific members say, hey, matter of fact, you had 17 of the 19 Fed members say, if we get above 4.2, we think we've gone too far. Well, 4.4 is above 4.2. To me, that was the first warning sign, right? To me, that said, hey, I think that's enough to make the 50 basis point hike. I think that's enough for them to go, we have a problem, right? I think going into this meeting, 25 was a foregone conclusion. Hey, listen, you're going to get 25 regardless, but is there a chance at 50? And I think that 4.4 on the unemployment rate was what put it over the edge with the combination of the BLS revisions that came out on the yearly revisions. And Powell talked about that at the podium. Powell got up to the podium, and that's real interesting. I kind of want to take a minute to talk about that whole podium speech, as well as the Q&A that was, planted for questions that, you and I could have knocked out of the park. Those weren't very hard questions for him. It was almost like a parade because they did the 50-point cut. They put people in that audience, and they planted those questions for him to knock out of the park. But I'll get to that in just a moment. But the reality was this, is that moving forward, it's not so much about inflation, because they've hit that target number, 2.5, 2 point whatever, the two's on there. They've hit that. They've achieved that. They've openly admitted they don't need to do any more with rates and be restrictive to keep that number there. Now, you could argue, hey, inflation may go up a little bit like we saw in the CPI. It went up a tenth of a point, and then the year over year was flat. But the month over month, or the expectation was up, and then the core actually was flat. So you could argue that it might go up a little bit, and that's CPI. The Fed does not really look at CPI. If you've heard us preach on here before, their favorite form of inflation is the PCE model, and that has been flat. And so you could argue that they flattened out this inflation curve for now, right? You could argue that. And there's another argument as to why it might go up. That's a whole nother podcast. I'll touch on it briefly here. But I don't think 50 basis point is a strong enough argument for why inflation could go up. I think the 50 basis point argument is, hey, listen, they're concerned about the labor market. That's what that told me when we got that 50 basis point cut. As a person that follows this, as an analyst that looks at this, that 50 basis point cut said, hey, listen, we think there's problems in the market, and we believe this will help, right? So when you're looking at future moves over the next, really, what are we at? We're in the month of September. So over the next quarter, we're going to have 2 more meetings. How are those meetings going to be kind of forecasted? What is to come? Well, watch the labor market. We've talked about that. There's major indicators that come out monthly, and then weekly, there's the unemployment numbers that come out from the form of, I say unemployment, the initial jobless claims report is what I'm talking about, people that go get unemployment. But here's the thing that I think was interesting. Powell gets to the podium, 50 basis point. Everyone's like, yay, we did it. It's great. We have all of these, all these people from the press in the front row. And again, asking softball questions to him. Nothing hard, nothing difficult, because everyone's excited we got a 50 basis point hike. Prior to this announcement, you've heard me talk about this mole that works at the Wall Street Journal that has, for whatever reason, has an ear to the Federal Reserve. This person leaked about 48 hours before the meeting that it will be a 50 basis point cut. Now, the question I ask myself is, why is this person leaking that information? Well, because it's sending the signals to the market. You've heard me talk about this before. The Federal Reserve likes the market to know what's going to happen before they do it, because they don't want to create any shock. They don't want to create anything that's going to alter the markets. And when I say the markets, I mean the equity markets. They don't want to do anything that's going to alter that. So forecasting and shadowing their events of what's going to happen helps the market digest that and gives them 48 hours prior to. That's one of the reasons why you have the mole, the Wall Street Journal, reporting that information prior to it happens. 40 hours before, if you follow that, you kind of knew, hey, listen, this was a foregone conclusion, because this person's announced it, and then that CME watch tool flip-flopped. You went from like a 25% 50 basis point hike to a 75%. It's almost like the entire market had already baked that in. And that's why we saw that dip in rates 48 hours before, because the 10-year was baking it in, as well as the other mortgage-backed securities were baking that in, because we knew it was coming. Powell gets to the podium. Interesting thing. Talks about what they did. But he specifically said they are not concerned about the economy, that they're in a healthy economy. And that this 50 basis point hike really wasn't to help the economy. It wasn't to establish any type of, threshold to help unemployment. It was essentially to get back to neutral. That's what he said. Get back to neutral, meaning that they may have felt like they were a little openly stated they were a little slightly restrictive, but this was to get it back to neutral. So 50 basis point hike took us back down to the 4.75 range, and that was to get us to neutral on the Fed funds rate. Now, I find that humorous, because we're definitely not in neutral. We're still in restrictive territory. And I also don't think Powell can get up to that podium with a straight face and say that we're in a healthy economy. Because later on in that statement, he said, no, this 50 basis points wasn't to address the employment issues. We're not fearful of the employment issues, but we are watching it. And we are aware of the massive revisions. I don't think he used the word massive, but we are aware of the revisions. This was the statement that said it all to me. We are aware of the revisions from the BLS reports of the corrections, the negative revisions, meaning that he even said that those numbers may not be as accurately reporting as initially anticipated. Well, no shit, man, because they came in. If you look at, dude, you're 818,000 jobs off. That report was a negative 818,000 on the year off. So when you look at that, that's not slightly off. That's big time off. I mean, if you made if you had a report that was off at your job, 818,000, you probably wouldn't keep your job. That's kind of how that works. And for Powell to get up to the podium and say, well, we realize there's some things that were off. Yes, it was off. And more importantly, he said, I don't think that the current unemployment rate, which we're watching, it's very important to us, is what he said, at 4.2 is really that high. It's not really that high. Yeah, it is. Even 17 of your 19 members have said 4.2 is a problem. And you were at 4.4 the month before, but 4.2 is not a problem. Well, here's the thing about that. That's the unemployment. That's the U3 reading, right? So just for our audience, there's two types of readings here. You've got the U6, and then you've got the U3. So what's interesting about this U6 is in 1994, we went away from the U6 unemployment. Well, right now, U6 unemployment is right almost at 8%, at 7.9. And the difference between those two is on the U6, it measures everyone that's not working. Whether they're getting unemployment benefits or not, it measures everyone that's not working. Well, the U3 does not do that, just measures unemployment benefits. So we changed in 94 to that reading. Well, he's up there touting that that's relatively low compared to history. Well, it's only been around since 1994. I mean, let's compare it to what it's been since 1994, and it's actually not as relatively low as he's stating. I'll take COVID out of the picture. That's a different thing, but it's not as relatively low. Plus, the population, the work population itself has grown significantly. So as you increase the amount of people working, that number should come down anyways because you have a larger pool of people to work with as far as counting numbers. So it should be lower. So in reality, that 4.2 is actually a higher number of people than it was going back to 1994. And it's interesting because, again, the U6 is a much higher number. It's not a healthy number to begin with. It's not a healthy number. So to stand up there and go, it's really not that bad. Well, I mean, we're not comparing apples to apples when we make that statement there. And the economy, for example, is not in good shape. And I'm not saying that, you've heard me get on my whole pulpit about independence and the Fed's independence and how they're supposed to be independent from the government and how sometimes they act and say and do as if they're not independent. This is one of those moments. This is one of those moments where I think that, you're bought into what the current administration's saying and you're saying it because it's not. And this isn't a personal opinion. This is data driven. When you have more people working more part-time jobs and more second jobs than you've ever had in the history of the United States, that's not a healthy economy. When you have credit card debt as high as you have it right now because people are having to debt finance just to live, not their lifestyle, just to live, that's not a healthy economy. When you still have the price of groceries almost tripled what they were from 3 years ago, still not a healthy economy. So there's a lot of things pointing towards 4.2 unemployment, not a healthy economy. You can make arguments for why this is not healthy, and I don't see many that come back and say it is healthy, other than maybe if you want to look at the equities market and say, listen, they're all-time highs and things are doing well. Well, that's because the Fed's driving that. The Fed has been driving that with the signals they've been sending to the market to anticipate all the changes that are happening. There are reasons why that is happening. You could also argue that, hey, listen, if the Federal Reserve didn't make this cut, could you imagine what would have happened to that equities market that was anticipating that? It would have had significant changes, just like it did back in July when everyone was expecting a quarter cut and it didn't happen. What happened? We had an entire week of the equities market go off the rails. We had some of the largest losses in one day that we've seen. And the Federal Reserve backed up pretty quickly. What was everybody calling for? These emergency cuts. Hey, we got to have an emergency cut. And they didn't do anything, but they sent smoke signals of what was coming to correct that market. And it did. And then they also released 40 hours in advance a 50 basis point cut just to let the markets digest it. And they did. And to me, that was interesting because it's a pattern of behavior we've continued to see. The other pattern of behavior that we've seen, and this has gone on since the 90s, is quantitative easing. We're officially in quantitative easing right now. As much as we want to deny it, maybe some people argue with it, we are there. And what is quantitative easing? Quantitative easing is when you reduce the Fed funds rate and when you stop tightening, you stop the runoffs of the balance sheets, right? Stop the runoffs. And they've stopped those. They stopped those about 6 months ago, maybe 3 meetings ago. They stopped that. And so now they are pumping the differential that they are making back into buying more treasuries. And you're effectively in quantitative easing, and the QE is in effect. Now, the one thing I know about QE with the Federal Reserve, history tells me that is a very addictive personality and that the Federal Reserve is addictive to that. And what I mean by that is you just look at ZIRP, the zero interest rate period that we were in. That was almost a decade we were in that. And there are many of patterns of behaviors from the Federal Reserve that show when we get to a peak of the Fed funds rate, there's a massive downward slide that happens, and that's that addictive policy coming back in. That's QE at its finest. Well, we've peaked, and we just took a step down. You can bet that this pattern of behavior will continue to happen over the next year, year and a half. And here's why I can tell you that. Let's look at the dot map. So the Federal Reserve, and this is in our show notes, okay? So if you go to our YouTube channel at What's Your One More, that's with the number one at What's Your One More, subscribe, take a look at this. You know, a couple things I want you to look at on this dot map. And my producer, Charlie, will put this in here. So again, we've talked about a whole episode about what this means. So the dot plot map is where they survey all the Federal Reserve members. And they go into each year and they say, based on a yearly basis, and sometimes you can see they kind of dot map it by quarter or by half year. And if it's substantially different from the previous one, they'll release it to the public. If there's not really much of a difference or nothing to jump up and down about, they won't release the dot plot map. So it wasn't 2 meetings ago that we got one of these, and now we got another one. So this goes all the way through. The previous one was in June of 24, and now you get this one of September of 24, and it goes all the way out to 26. You get a longer runoff here, maybe even 27 in some cases if you really look at this. But the reality is there was enough of a change for them to publish this and put it out there. Well, what you saw the change is that almost in unison, the entire 19 Federal Reserve people that put on the dot plot map here moved significantly in 2024, dropping down the Fed funds rate all the way down to, somewhere in that 4.25 range. And then another significant drop in 2025. We're in the mid threes, lower threes. And then in 26, we're in the 2.5, 2 range. And then in 27, we're in that 2 range. That's that addiction I'm talking about. That's that quantitative easing. That is exactly what they're notoriously known for because that's all they know how to do. This is what happens. We have really, as the Federal Reserve, they have 2 particular bullets in their arsenal, if you may. Number 1 is raise interest rates. Number 2, lower interest rates, right? That's the 2 arsenals, right? Now, you've got a couple of arrows that you can use if you want to kind of use this analogy. You got a couple of arrows back there you can use. One of them is buying treasuries. The other one is buying mortgage-backed securities. Those are your defense mechanisms. Now, the opposite of that would be not using those arrows, not buying mortgage-backed securities, not buying treasuries, and not tightening to the point to where you're doing the balance sheet runoff. That's what we've experienced over the last 20 some odd months. Now we're back into the thing they like to do, which is the addictive personality of quantitative easing. And that's why this dot map is kind of foreshadowing what's about to happen here over the course of the next 2.5 years. You're going to see that type of runoff. And what's interesting to me is there's this, you'll see this chart here. In 2024, there's this one lonely Fed member that said, hey, listen, in June, I think we're going to be like 4 1/8 in 2024 on here. This one lonely Fed member, and then that person's is now in line more at 4 1/4. You don't really have that kind of lonely disparity anymore. But I can tell you that there was one person sitting in that room in June that said, hey, listen, I think we're too restrictive. We need to fix this, and we need to get lower on our policy. And then all of a sudden, you see the rest of the Fed members get in line with that person. And here we are at the end of 2024 talking about potentially somewhere between 4.5 and 4 1/4. So that tells me that we have another 50 basis point hike left, cut. I don't know why I keep saying hike. I guess we've been doing it for 26 months. But we have another 50 basis points to come down to get to this majority rule level here. That's interesting to me because that's fourth quarter and it's coming up right now. And as we shift into the first quarter of 2025, the entire majority of the Federal Reserve is saying 4 1/4. You got one lonely member that's saying maybe a little less than that. But I thought that was interesting as that move takes place there of what you see. And then mid-2025, the entire group's in the 3s. That's interesting. That's the addictive personality. So I just wanted to share that because to me, that's another foreshadow of things to come. It also tells me this. They don't believe the job market's getting any better. Because if they thought that job market was getting better, they wouldn't want to put this thing in the 3s by Q1, Q2 of 2025. They would say, nope, we're good. We're going to continue to fight inflation. We're going to continue the mandatory mandate of policy to get to 2% in the core PCE, and the labor market is strong. In behind closed doors, the conversations, Powell was asked. He was asked, hey, behind closed doors, how did this go with the 50 basis point hike? He goes, no, I think we were all on the same page. We understood that. Because that labor market is potentially a problem. And we've talked about unemployment, how it could be a runaway train. This dot map also tells me they realize that, hey, in unison, we think there's a problem with the labor market, hence all of these downward pressure, of cuts that they think are going to happen and need to happen. The other thing that happened coming out of this meeting that I think was important was from that 48-hour signal that they sent to the market. We finally saw the inversion of the 2-10 treasury curve get back to the positive. It went from inverted back to normal positive territory. Now, I'm not going to spend a lot of time on this, but if you follow this show or if you follow a lot of economists, there are very strong, very, very strong correlations between an inverted 210 treasury curve or 10, 10, 2, 210, whatever you want to call it. There's strong signs that show when it's inverted, next 12 to 18 months is a recessionary pattern. Now, what's interesting to this, and this dates all the way back to the late 70s. You can even go further back than that. But you're going to see this graph. Again, this will be in our YouTube channel. If you're listening to the show on Spotify, if you're listening to it on Apple, give us a quick 5-star review. Leave us some comments. We'd appreciate it. But if you're also a visual person, we're putting these graphs in our YouTube channel at What's Your One More with the number one. You can see this. But what's interesting to me on this 210 is how long this thing was inverted for. I mean, we haven't seen an inversion period like this since the 80s, late 70s, early 80s, and we know what things looked like then. But this is a rather long duration and a deep duration of it being an inverted period during this time frame. And now we're uninverted. So the question becomes, now that we've got out of that level, what's to come over the course of the next 12 to 18 months? And what this means is that when it's inverted, it means that the price of the two-year note versus the 10-year note is greater, meaning that you're making more yield on the 2-year than you are on the 10. That tells you that the market is saying there's more risk in the short term than there is in the long term, because if you invest in a longer 10-year note, you should be receiving a greater return because of the risk of the 10 years, that money being tied up per se. And if you invest in a short term, it should be a shorter rate of return, a less rate of return, if you may. When that's inverted, it means the 2 years has a greater rate of return. So why would you put your money in 10? Well, it's because the market's offering you more return because they think there's more risk in that short term. That's what that means. And now we're out of that period. And that's interesting to me because history tells us coming out of that a potential recession does follow. And I think that the labor market is a leading indicator to show that of what things could be to come. Also, I know the Federal Reserve knows this and they know it better than me. I think they battle that by lowering interest rates. And that's why you see the dot map look the way it does here. Guys, I hope you like what you're listening to here. If you would, please 5-star review this podcast, share it with a friend. We're on every platform you listen to your favorite podcast on. Check us out our YouTube channel at What's Your One More. We love the comments and the feedbacks you guys are giving on here. And hey, for us, it's a finally, hey, listen, it happened. We knew it would. There's variables were out there over the last 2 years, but everything lined up as we had said it was going to. Once those variables were removed, we started to see all the indicators happen and show us what was going to take place, which is why the 50 basis point cut was not shocking to us as we anticipated that to happen. So I hope you guys are enjoying this. Thanks for tuning in. We'll see you the next episode as we break 200 here at What's Your One More.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.